Good morning, everyone. Thanks for joining today. A couple other things on my mind as we continue moving through 2025 and this interesting real estate market that we're in. I had mentioned this on a previous video about the different business models that we use at the Peak Group that you can use to invest in real estate. And one of those models is called the concierge BRRRR model, right? And we do this primarily in Birmingham, Alabama. I shouldn't even say primarily. That's where we do it. That's it. We've got some other markets that we're looking at where it could work, but this is intended to be a little bit deeper dive into how that works. When I talk to investors who have done BRRRR before, which stands for buy, rehab, rent, refinance, and repeat. I got to think there's a lot of R's in there, but that's what it stands for. Those who have done it pick up on this and why it's important really quick. But if you haven't considered it before, I want to lay it out and just get more specific about how it works. And we'll have our team in Birmingham on a show here with us soon to really dive into the neighborhoods and some of the things that we run into when we're doing this. But we're sitting here in 2025, and this market this is a weird one because rates are elevated compared to where they were. There's a lot of people that say, well, they're historically lower than they've always been. Yeah, I get it. But, when you've refinanced properties like I have at a 3.625 mortgage rate, you can't unsee that. You can't help but wish for the glory days of those low interest rates. Now, it turns out, as we're sitting here in 2025, those low interest rates have consequences, and we're experiencing those right now. Right? High rates in the treasuries, high costs, inflation, all those things that we've been dealing with. And that's a consequence of the easy money that we've experienced. So pros and cons. I love the trade-off analogy. So as we've dealt with that and these higher rates and how hard it is to get properties to cash flow, especially on the new construction side, it makes us say, what can we do to attack the problem? What can we do to make it so investing requires less cash flow? How can we attack expenses? How can we generate more income? Because we've got high rates. I think land prices, and this is very local market sensitive, but land prices have eased a little bit. I'm not a ton, but I've noticed land sellers, as I record this, are a little bit more forgiving on their terms. I remember in 21 and 22, land sellers would say, I've got land, you want it. If you're not paying me 20% more than I want, then take a hike. You say, well, how do I know I can even do with this land what I want to? And they say, you don't, but I've got it and you want it. Right now it's, okay, here's my price. I'm not moving, but yeah, I'll give you the time to get your entitlements, to get your approvals, right? So it's moved a little. Construction costs have moved a little, but it's still sticky. Right. And we're forced to deal with, we've got a new president in the office talking about immigration and tariffs. And wherever you sit on that issue, I think most of us go, well, that might affect construction labor. Right. You look at the typical American citizen. I've got teenagers. They're not thinking about becoming an electrician. They want to sit at Starbucks and record TikToks, which is now legal again, I guess. There's a minute there where it wasn't. So we have less labor and a growing population. So I don't know that construction costs are going to move in any kind of meaningful way. That's just my opinion. We look at the materials cost too. It's just getting harder to produce a lot of that stuff. And there's this onshoring movement happening right now where we want to produce more in the U.S. And so we look at all these things and we look at the pretty stubborn inflation and we go, is this the new normal? Is this just what it is? And we've got to figure out how to move forward while all of this stuff sorts itself out. And it could take a while. And so this BRRRR program is something that we thought about as a way to generate alpha, as they say, go out there and attack it and produce a return because you did something innovative. Beta return is, the market just went up and you were in it. Congratulations. But alpha is when you made something happen. And BRRRR is a good way to get aggressive and to make something happen. So in the previous video that I did, I kind of outlined it, but I'm going to get more specific here. I used to own a franchise. It was called Homevestors. You've seen those We Buy Ugly Houses posters. They're in a lot of cities. And that's exactly what we did. I bought some ugly houses. And that's what you have to do in BRRRR, right? You have to go buy a house that has a lot of equity in it. And the only way that you're going to typically do that is to buy a house that has problems. I've done closings in some interesting places with some interesting situations, right? One house that got raided by the FBI because they were doing not so good stuff there. One closing where I had to get doc signed at a prison. There's a lot of stuff where, parents went into a nursing home and the house had been neglected for 20 years. Lots of heartbreaking situations there that unfortunately they're just part of the human experience and they happen. And so those homes need to be sold and they need to be sold quickly for cash in most cases. And that's what we do. We work with a network of investors there in Birmingham that bring us these deals that have problems. And because we have the cash to take the deal down, we can get that quick closing. So that's what you're going to do. They bring us a contract and say, "Hey, we've got 123 Elm Street under contract for $90,000." And we say, "Well, that's pretty neat." And we have our construction team go out and they assess that this house built in the early 1980s needs $30,000 worth of work. It needs a new roof. The backyard could use a lot of cleanup and maybe a new retaining wall. It needs new plumbing fixtures and counters and paint and carpet and all that kind of stuff that it's going to need. And so I'm just throwing out numbers, but $30,000. So it's under contract at 90. We stack on that renovation budget. So you're all in at $120,000. So cool thing that we have going here at Peak is we have our own hard money fund where that hard money comes in and you, the investor, put up 20% of the cash of that 120 and our hard money funds the rest. And so we make a wholesale fee. We make the hard money fees. This is a way for us to make a little bit of money at every stop and for you to make a lot of money over the life of the property. So you buy the property and it comes in a package with pictures and financial metrics. It comes with a scope of work as to here's what we're going to do. It comes with standard features of this is what kind of flooring we're going to put in. This is what kind of counters we're going to do. And it makes it so all that stuff, there's nothing left to the imagination. You know exactly what's going to happen with this property. It comes with our construction agreement. So you're hiring the Peak Group to do this construction work, as well as the loan agreements with the Hard Money Fund. You sign all that stuff, wire your money to the title attorney, and now you own 123 Elm Street, and it's a dump, all right? And that's okay. That's what it's supposed to be at this point. And our guys pull up to that thing with a 30-yard dumpster or two, and they clean this sucker out, and they tear out all the old rotten stuff, right? And they get to work. And this is going to take, on a very quick one, 30 days, but in most cases, probably 90 days, maybe even a little longer, right, to complete this renovation. And you're the owner during this time, and you're going to sign a couple of draws along the way so that our team can pull the funds out of the hard money loan to pay for the subcontractors and to get this work done. Cool thing is you can be in Seattle while we're doing all this. And that's why it's so attractive to people, especially a lot of investors from the West Coast or Hawaii or the East Coast or even overseas where the real estate is prohibitively expensive and you want to generate that good return, but you can't go to Birmingham or some of these other markets where it makes sense. So we're doing all this. And then as we get to the tail end of that renovation and the property is, looking respectable, our management team steps in and starts looking for tenants and they'll start marketing it. They'll start doing showings. And so this property that you're all in at 120,000, because these improvements went into it, it might appraise for 200,000. Once again, my math, I've not done a spreadsheet on this, but we have this stuff that you can request where we have done all the financial modeling for this. And so now you can pull a good chunk of that initial equity that you put in back out because the property is appraising for so much more than what you're in it for. And that pays off the hard money loan because you want to get rid of that thing, right? Hard money is expensive because it's designed to solve difficult problems quickly. And you replace that hard money loan with either a Fannie Mae 30-year fixed conventional loan, and I'll have our lender on soon to talk about the differences in all these. Or a popular loan these days is what's called a debt service coverage ratio loan. This is kind of like a commercial loan where it just looks at the property and a lot less at you as the investor. These are a little more expensive, but one cool advantage to them is they typically don't have a seasoning requirement. Oftentimes when you use a Fannie Mae conventional loan, you have to own that property for a certain period of time. I think it's 6 months before you can pull any cash out. So You might just decide to leave your cash in and do a cheap Fannie Mae loan, or you might say, I want to pull some out immediately and I don't want to wait 6 months. So you get that debt service coverage ratio loan. And the cool thing is, all right, now it's renovated. The management team has leased it. You refinanced it. You're getting rental payments, right? You're all in on a property for a lot lower, I would say 10 to 15% down payment, as opposed to 20 to 25% that it would normally take if you bought that $200,000 property when it was already renovated. And so we repeat. That's the last R in BRRRR is to repeat. So we're going to take some of that cash we got back out and some other cash, and we're going to go do it again. The idea here is, and it's not going to be exact because the market and tenants don't care about your spreadsheets, right? We can model this stuff all day long, but the market doesn't know you even have a spreadsheet, okay? But this is kind of a general guide that we're going to use to follow this business model. So the way it really looks is, can we turn $250,000 or less into 10 properties? Right? And can we do it and just extend that leverage for you? But you can see you're out in the space, you're operating, you've got to trust the P group to do its job. But you can typically get into these properties for a lot less money down if you take the time to understand this process. So when we get going with this, what it probably looks like is at any given time, you've got one property under contract you're about to close on. You've got another property that's in renovation. You've got another property that's finishing and getting refinanced, and another one that's been done for a couple of months that's now cash flowing. And you're just going to cycle in and out until you've maximized the equity that you want to deploy into this system that we've created. What everybody really loves about it, when I tell them about it, is they say, well, what does it take to get started? Almost nothing. We're going to have you talk to our lender to make sure that, yes, you've got the funds and the equity, and that, yes, you can pay the hard money off that we're going to loan to you. And that's it. And you say, I want to try one of these things out. And when our wholesalers bring them to the table, we'll send you the package and we'll say, do you want to go forward? And you either do or you don't. Maybe you try one or two of them and you just don't love it. You don't have to keep going, right? You can get on or off of the program. But here is the kicker. We can only do this with probably 3 to 5 investors at a time, because these kinds of ugly houses that have problems that need renovation are a finite resource in a market that is finite. We can only get so many of them. So it's important that you reach out to your advisor at the Peak Group to talk about, hey, do you have any slots in the BRRRR program right now? We can send you our deck that has a great case study that goes through this top to bottom as to how the program works. But this is a great way that we think that you can generate some alpha, that you can generate some returns in this market that just isn't making a lot of sense right now. I still love the quote, the age-old quote by Warren Buffett: be greedy when others are fearful, and fearful when others are greedy. And they're kind of fearful and apprehensive right now. And with the backlog of new housing not coming into the market because of the prohibitive interest rates and just the difficulty that we've all been experiencing, I think it's a good time to start to get going, because it's that, I'm using all these quotes and I'm probably butchering them, but I think it was John Rockefeller that said he knew it was time to sell stocks when he was getting tips from the shoeshine boy. I've heard it said a bunch of different ways, but when everybody's on board, that's when you got to question. When people are a little scared and wondering if you should do it and does it work, it might be time to go. Easier said than done, though. Either way, we hope you join us at the Peak Group. Thanks for your time today.